സ്റ്റാർട്ട് ആയിക്കോളും. സർവീസ് ചെയ്തതിന്റെ പൈസ എത്രാന്ന് വരെ എന്നിട്ട് നാളെ ഇതിനകത്ത് ഇട്ട് കൊടുത്താൽ മതി.
Can everybody see the screen?
ഓക്കെ.
Stop last time in the business case, right? I think I stopped here. So I think we stopped here, I think. Business case, right? So I think I explained what is business case. Like business case is something like any project that you will treat on like what do you call it? Any investment you will make or any if a minor project that we are working on will be considered as a business case. Right. So what is I think I explained this slides also to you because this explains like the people online, if anything, if you cannot hear or something, stop me, or text me if you cannot communicate. Well, I'm going to minimize this first. Okay, so it will be there will be 5 pillars which we will be analyzing to understand on the business case. One is strategy, which is the new capabilities and improve competitive position. That means like it's a strategic decision, right? Why we will do a business case. What is the purpose of doing a business case? We are already in a business. So if we are going to do a business case, there should be a strategic motive, right? So new capabilities and improve competitive position. That is called strategic, right? We want to like, okay, we have a path, we are already traveling. I have a business revenue. I have a business operation. So why I will analyze on a business case because I want to do more. I want to increase the profit. That's a strategic one, right? I need to increase the capability or increase the profit. That will be a strategic pillar. And then operations, which means process improvement. Already we have a process. So maybe we have to improve that process. If I'm in manufacturing, okay, I would say like, okay, I have certain equipments and I follow ABC in the production section. Maybe there's a new machinery. I'm changing the process, or I'm changing the process to go to something related to what you call being being what you call machine automated to something like before with whatever with the manpower or like with the manpower kind of the labor oriented one, we will shift to machine oriented. Now from machine oriented, we are shifting to AI, right? So that's a process change that will come in the operation where return on investment is like what you call overall aspect and financial. There should be a cost benefit. Why I will do something without I don't have a positive impact on my PNL. Of course, I will be expecting a financial gain. And same with innovation, maybe R&D, research and development for new product, or if I want to invent new. So overall, what is the benefit of having a business case is to the strategic move to increase the profit or the capability of the business that we are doing. So business cases are created to help decision makers ensure that the proposed initiative will have value and relative priority compared to alternative initiatives based on the objective and expected benefits laid out in the business cases. And the performance indicators found in the business cases are identified to be used for the proactive realization of the business and behavioral changes. So basically, we will be considering what? Benefit, cost, how much we are impacting, what are the risks associated with them, and the timeline or the duration. So how they will from the how the business makers will take the decision. One, the proposed initiative will have value and relative priority compared to alternative initiatives based on the objectives and expected benefits laid out in the business case. Because we cannot simply see one, because there is going to be anyhow lot of alternative. There will be option A, there will be option B, there will be option D. So my analysis is to find out which is beneficial for me, and I will choose from the three options what is better for me to take it. And the performance indicators found in the business case, it can be a benefit, it can be strategic one, it can be operational improvement, it can be research and development improvement. So all these indicators in the us to be used for proactive realization of the business and behavioral changes. So overall analysis, I will check, okay, what is positive to me based on the existing opportunities or the availabilities of the cases you have, and I will choose the better one for me. Right? That is the analysis of business case. So components of a written business case, there will be an executive summary. There will be a current status. What is the status now? So executive summary, what you will include? You will include the summary of the total business case that you are going to present. And then we will move to the current status. What is the existing status? For example, I am recommending something for the improvement or moving into a sustainability, a business case. So then I will put like overall benefit of benefits of sustainability. What is the status of sustainability in the organization in the current context? And then what are the improvements I will make? Just as a summary. And then I will go to the current status. Then I will list one by one. Okay, this is the status. We don't have anything, or we don't have a committee, or we have a committee. And these are the current sustainability goals we are doing. This is how to implement. Those things I will put. And then the assumptions, what I will assume, what will be my deliverable, that I will write. And then the business analysis. Okay, whatever I'm proposing as an assumption or the proposal, whether the business analysis, we will say like it's feasible, it's not feasible, it's positive, it's negative, how much is going to be the value that we will do. Then, of course, even though it's bringing a positive output, there will be, of course, risk to that. Anything will have a risk. So then we will see the risk analysis with this implementation, and then we will recommend with the goal and timeline. What is the goals to be achieved and what is the duration it's going to take. So these are the items will be covered in the written business case. Now quantifying cost and benefits. Cost benefit analysis. It is a part where we do in any project or any business case, we will have a cost plus benefit. There will be a negative and positive. So cost benefit analysis is a technique used to compare the total cost of a program or a project with its benefits using a common metric, most commonly monetary term. Money we are using to value. If we expand, if you what do you call, if you're trying to spend something, of course we will expect some benefits from that expenditure. So we have to see and quantify. Okay, I'm spending 10,000 on something else. I'm going to buy an asset. Okay, I'm going to upgrade a chiller. I'm putting 25,000 on that. What is my benefit? It's worth or it's not worth. Okay, why am it should be worth? Yes. 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 Yeah. Yes. Exactly. That's the what you call the complete one. But we need to analyze on scenario basis. Like for that project, what is the design value of the chiller that we require? Life will be more, and how will be the maintenance cost will impact that. When you have a chiller and you have to do lot of corrective maintenance on periodic basis, then there is no point. And when I bring a brand new chiller, there will be maintenance free for 5 years, 10 years. I can use it without less issue. And as he said, the energy that it consumes will be less, of course, than a 10-year-old chiller. So there will be a benefit out of that. So I will quantify everything. Now when he is proposing, he will bring the chiller value only. Okay, $50,000 for the chiller. This is what we will see visibly. Right? How do we know that? What is the what do you call indirect cost or indirect benefits that is vested in that chillers? We don't know, because for a management or whoever you are bringing, you will only see $50,000 cost for the chiller. But what will be the benefit of that? I will have to add the benefit of what do you call the energy savings, the maintenance cost that will be less. Then I will quantify everything and I will add, and then I will see, okay, how much I spent, how much is the positive. But at the same time, you cannot get it in 1 month. The investment I am putting, it's going to give me in the payback. I cannot get in 1 year the total saving. Of course, it will not come $50,000 in 1 month saving. It will be in the long run. So I will see like the complete what do you call lifetime, complete lifetime. I will do an assumption to calculate that benefit, and then I will compare it with the cost and then the benefit to identify whether this is a feasible project, which is a viable project for me. That will be the comparison. So the following analysis are a part of business case, cost and benefit, which will use best value, life cycle costing, and benchmarking. We know life cycle costing, what it is we have discussed, but what is best value? Benchmarking is something we benchmark the price. Okay, in the industry and everything, there is industry benchmark prices. We will know. You will do a what you call a pre-qualification analysis or something, and you will check for a certain product how much is the price in the market, how much it is selling. Everything we can come to know, because people will not give you what you call a very exaggerated prices. In the market, it will be available. So that is called benchmarking, benchmark price. And best value mean what? We are getting the right quality with the right cost. That is called best value of any what do you call any product that we are purchasing. So in business case, we need to analyze both of these. Best value. Okay, I'm getting a quality one with the cheapest of. Not only the cheapest in monetary terms, but does it fulfill my needs? And its quality is enough. So I need to ensure that it's okay, it's best value. And then life cycle costing. I need to consider from the product that is from the production time until it is being disposed, and then benchmark. So I will compare everything when I do the cost benefit analysis. So capital investment and time value of money. So capital investment refers to funds invested in a firm or enterprise for the purpose of furthering its business objectives. So we already discussed, I think, capital investment. It can be anything. So for any organization, I said like, there will be two expenses. One is operational expenses. There will be capital expenses. So operational expenses we already discussed, which will be like, for the consumable, on routine basis, you are, whatever you are spending on this petty cash or small minus spare parts replacement. This cannot be a capital investment. But what about painting or changing a major asset of your thing? You are changing a complete age or something. It is an asset. Why? Because it will work for you more than 10, 15 years. So it is considered an asset, not as an expense. Or it's not going to be something, if you want to change an ER unit or an AH unit, it's going to cost you around 200,000, 300,000 riyal, right? Minimum. So in that case, what you will do? You cannot just write it off in just in 1 month as normal cost. It will be a capital investment which involve depreciation, and then only we can analysis, right? So for that capital investment, we have to consider option. You will not go and blindly buy something, right? Okay, tomorrow you have a requirement to buy an AHU. You will go and buy with a spec only, or you will see in the market, right? Okay, maybe something. Okay, if you want some specific brand, I don't mention anything specifically, but I'm telling that sometime for career. Maybe if you go for career with the spec, okay, that's you will get it only from career, not from other places. But you have to see the capital investment also. You will do an analysis for your side. How much you are investing, what is the saving? You are gonna what do you call dispose the previous one. Right? It's not a new installment. If it's a new one, we are not going to do because FM is not going to do for a new one. It's in the construction side. They will do the analysis, whatever it is. But that is as per the design that the engineers have created already. But for us, what will be the concept? For us, we will see the life cycle costing for that particular product from the day one itself until we dispose it, how it's going to be. And you will observe it minimum, you will check with the other market, how much is the price here. If you're a big company, you can directly get it from Dubai, you can directly get it from some parts of the house, and you can do the fabrication or something. And you can go for another units which is not career oriented, but it satisfies your one with the best value. Right? It's not cheapest option, but of course it can be fit the purpose with the right amount of cost with the quality. That can be a best value option. So for this, there will be a time value because why? It's gonna be in 10, 15 years. It's gonna take 10 minimum 10 years, 15 years to realize the investment value, full value. So for that, we studied there is a value of based on time, there's a value for money, right? Not the same amount of money I have now will worth the same amount in the future. Right? So capital investment refers to fund invested in a firm or enterprise for the purpose of furthering its business objectives. So it's normally it's like an expansion. Why I will do it to expand whatever I have, right? Any like building, painting. Why expand what building asset value? Whatever I do as an enhancement will enhance my asset value. If I just paint a big high-rise building, it is not an expense for me. The property value will, what will happen to the property value? It will go high. If I am changing some of the major assets, what will happen to the property value? It will increase the value of the property. So overall, I have a gain there. I will increase the market value of the property, right? So capital investments are such costs which are used to enhance the property value. I think we did this or no, right? I think similar type we studied, but not this one. The time value of money is the concept that money, I think similar thing we studied, I think not the same. I didn't come to this slide. No. Time value we discussed in the previous chapter also. But I think this is a different one. That is a different one. Because I didn't touch this slide. Time value of money is the concept that money available at the present time is worth more than the identical sum in the future due to its potential earning capacity, which we discussed already. So it's also they have a you can see a formula there. Future value equals present value to 1 plus I to the power of n. So n is number of years. It's the same formula that we discussed last time. So if it's 5%, means you will put it in decimal, right? 0.005. And number of years is also 5. So they have found out the future value of $1,000 in 5 years. So if you just $1,000 deposited in January 2009 will be on January 2004 is 1,276.28. That's why in 5 years the value will be different. If I'm considering the value in 5 years, I cannot consider it as 1,000. I will consider it as 1,276 in 5 years. So if somebody is offering me, okay, you give me 1,000 real, okay, and the current market interest rate is 5%. He's saying me in 5 years I will give you 1,100 as return to you. As interest, I'll give you 1,100. Some guys say, okay, I will give you 1,300. Which option I will select? Both are more than 1,000. But which option I will select? Which is the more we will select? And at least the base value should be more than the future value. I can take 1,100, but is it worth for me to take 1,100 by lending it? No, no need. Why? Because I can put it in the deposit in the FD or something and take that benefit. Why? Because the money he is going to give me is less than that. Because the value of that money, if I hold it, it will be more than I lend to him. If I hold it with me, it will be more. 1,276 in 5 years. So that's how we compare the value of money. In each investment, now for 1,000, 2,000 is okay, but if you do it in millions, billions, it's going to be a huge impact. So how I will analyze or forecast on that investment? Because you are not going to do, because whatever you invest now, it will come back to you. The return will be in 5 years, 10 years, 15 years, 20 years. So how you will calculate that return if somebody comes and explain you, okay, you take an investment plan, or you are going to invest in a property, you are going to buy something, you are going to invest in an apartment. How do you judge it? Because it's not like, okay, one day I buy, tomorrow I realize, and no, it will appreciate, go and appreciate it. The value will, of the properties will appreciate. How we will judge it? So we have to understand the concept of time value of money. What is the bank interest rate? How much it will be? Now I am spending will be how much in that year, and will that be depreciated? Because sometimes now in real estate, what they say, you can buy this property for this amount now. It will, the value of that will be 20%, 30% higher in maybe 10 years. So we go blindly and say, okay, we will buy 30% more. But the amount of money you hold will automatically, appreciate, or the value of that in 5 years will be less than that. Right. So it's gonna be automatically more. So why I will invest in the property separately? So I need to compare that difference, how much I will invest, how much will be the gain I will get. So that's why we do this calculation. But in CFM exam, you will not get this calculation, but it is for the conceptual understanding in practical life. As an FM, we should know why, because we are the people who are addressing. It's like, no, the finance manager will only give you the money. He will deal with the financial thing. But when you are proposing to your top management, who is going to do all this analysis? Okay. We are the one, because blindly, if I go to my what do you call director or my GM or CEO, I cannot sustain. I cannot expect that he might be a technically sound guy. He might be an from a different background, from commercial side. He will not go on too much on technical. End of the day, for any owners or any entrepreneurs, what is their best expectation is money, profit. So when I go and give him something to be as an expense to be sent, what is his first question will be? What is the benefit for me? So how I will explain this? All these analysis, who should do? We should do. Because in reality, you will be doing it. Okay, split unit replacement in practical. You might have it in your practical scenario. So how I will say, go to and say like, okay, I have all split. I'll have a huge maintenance cost. Okay, this is the cost I am incurring. If I tell him like too technical, this compressor is not working, PCB boards are damaging, not available in the market. He will say it's working now, it's working. Okay, let it break. This will be the answers practically if you go for them. Most of the top management, yeah, of course, they will do this one. But if you make a proper report stating that, okay, this is the amount of cost I am involving now per year, okay, and this is the life value of the asset. Already the life value is almost 70% or 80% completed. Now I suggest this much because I am incurring for the next 2 years or 3 years. This will be the expected cost I will spend. So that expected cost I am spending in 1 year, 2 year, 3 year. If you want to find the real value, you need to use the time value of money. Because this 1,000, next year it's not going to be 1,000. Next year it's not going to be the upcoming years, it's not going to be 1,000, 1,000, 1,000. Why? Because there is a time value of money. So this 1,000, next time it can be 1,200, next year it can be 1,400. It can vary. So you will do an analysis and give him a calculation that, okay, with the replacement of this split AC, uh, I am saving you an amount of $2,000 in 3 years. Something like that. Then he will see, okay, fine, at the end of the day, okay, I have money. This is the benefit I'm getting. Okay, let's proceed. So this is the way to approve. Why? Because the entire what do you call the operations in FM is seen as a cost center. It has been discussed as cost center. Even I am from a client background or I am from a service provider background, it doesn't matter. Wherever we go, wherever we implement projects, wherever we take on the job, it's seen as cost and budget restrictions. It's common in FM. So how do we tackle it? This is one way. That's why we study this project analysis, capital investment analysis, net present value. So this is some way that you tackle out these challenges and you show the top management that, this is the requirement and this is the benefits I have. And maybe the second time is what? Maybe in case they might ask you to do this analysis. They can ask you, they can say you there. Because you are, being FM, you might be responsible for real estate as per the company requirement. They might ask you tomorrow, okay, we are going to purchase this property as an FM, give me your feedback. I cannot simply go and say, no, I did an analysis, this is the market value and all. No, I will have to do something, what do you call theoretically, which is correct. I can prove, some standards one that everybody can compare. So that's why we are bringing on all these policies for whatever the concept to understand. It's not about in the exam, they will ask you to calculate the NPP or something. It will be just a common question, but understanding the concept, that is important. And where will be using it as an FM. That is the important part. Okay. So capital investment analysis. Capital investment analysis is a budgeting procedure that companies and government agencies use to assess the potential profitability of a long-term investment, right? Whether it's profitable, it can be done. If it's not profitable, then why I will invest money? There is not a need there to invest money, right? So projects are viable if net present value is a positive. NPV is greater than 0. Internal rate of return exceeds the opportunity cost of capital, which is base lending rate. For example, we studied 5%. Then if the IRR is 8%, then of course your project is viable. But if your IRR is less than that, IRR means internal rate of return. There's a formula to calculate it, but for you, it's in the business statistics or in the financial modules, they will cover it. But for us, they will give the IRR. It's just for the comparison only. Don't have to do the comparison. It's like about what about the money I invested, what is the recovery I'm getting into percentage. That is called IRR, internal rate of return. So you will see that percentage, and that percentage should be higher than base lending rate. What is base lending rate? What is base lending rate? Sorry? I cannot hear you. Anybody? Base lending rates. Rates. In Qatar also we have lending rates right now, CBQ. How much? 5 to 6%. When you get loan, the interest rate they are charging. It's not the bank deciding, it's the economy that decides the lending rates. They cannot. Now why don't they have big changes? 8%, 10%, 15%. Why they don't? No. The economy decides that lending rate. The central bank decides the lending rates. So then they can, make a change only to 1 or 2% maximum, but not more than that. That is called the base lending rate. Central bank will say, okay, this is the base lending rate. Otherwise, if they make changes, the economy will collapse. Right? So if the internal rate of return is above that base lending rate, then my project is viable. Why? Because I will get more than the interest I keep it in the bank. Okay. Then the cost benefit ratio, we take cost and the benefit, and it should be greater than 1. Why? Because cost should be less than the benefit. Then only I will get the ratio greater than 1, right? So that analysis I will do. And quick payback period. What is payback period? We discussed last time. Payback period is an investment that we make, and in how many years we will get that back. That is called the investment return. How many years it will take. So as soon as we get it, it's good. For example, I invest 1,000 riyal, and if I will get it only after in 10 years, then what's the point of investing in that 1,000 riyal? It's a waste of money. So if I do it 1,000 riyal and my payback period is in 3 months, I can consider. Just for example, I'm putting the value, but it's faster. But some investment which are very huge, of course, 10 years can be more beneficial. If you put in billions or something, if you get it in 10 years, you compare the other returns and everything, you can see that, okay, it's a quick payback. Because major project, they say like 2 to 3 years, medium one, major projects, 5 years. This is the payback period, standard one they are covered. But it depends based on each scenario, how it will vary. Okay. Minimize risk of capital investment. There are different ways to minimize the risk in capital investment. Of course, in the capital investment, the risk is going to be high. Right? We are going to invest more cost to increase the asset value. So the risk obviously will be high. So how do we minimize it? One is with sensitivity analysis and scenario analysis. So sensitivity analysis and scenario analysis also, I think we discussed it in the risk management module. I'm not mistaken. I think I discussed this with you. So sensitivity analysis means what? It is based on two factors. We analyze sensitivity analysis based on two factors which are variable. Okay. If I am changing the X, there will be an impact on Y. If I am changing the Y, there will be an impact on X. Either it can be a positive impact, either it can be a negative impact. So when we compare like that, that is called sensitivity analysis. So when we are doing a capital assessment, we need to see, okay, I will invest the cost. If I don't invest, what will happen? That change is called the sensitivity analysis. Scenario analysis means what? We consider each incident as a scenario, each option as a scenario, and do an individual analysis on the scenario based investment opportunities and check the risk. That is called scenario analysis. So managers typically start with three basic scenarios, which is base case scenario, which is most likely, worst case scenario, pessimistic, and best case scenario, which is optimistic. Okay, this is just the conceptual things. So key benefits include planning for future investment to determine expected returns and risks, proactively avoid or decrease potential risk of failures, and projecting investment return or losses by doing sensitivity or scenario-based analysis. And then we call it risk handling or risk mitigation. It is a process that identifies, evaluates, selects, and implements options in order to set risk at acceptable levels given program constraints, and objectives. It's risk mitigation we already did in risk management. Right? It is about converting. How do we do the risk mitigation? We will do a personal SWOT analysis, strength, weakness, opportunity, threat. We studied in risk management. Right? We do SME, failure mode effective analysis. Right? So these things we will identify the root causes of the risk causing it. Then we will see, okay, how do we control it? And then we will decrease it or mitigate it, right? So that is how we do the risk handling or risk mitigation. Okay. So each subject is interconnected. Whatever we are discussing before, because we cannot avoid sustainability cannot be taken off because it will be keep on continuing when we touch the other subject. Risk management will keep on coming on the slide. So that's like a connected chain with the FM. So up to this, are we all clear? I think you guys went and referred the previous thing that we studied before I go to fundamental post concept. I think in this chapter we studied about assets, financial statements, right? What is accounting, accounting ledgers and everything we studied, how an accounting entry is made, right? That we studied. And then we studied about the business cases, right? What are the types of, how do we make decisions on business cases? So far we have touched this one. So anyone have any doubt? Because I can discuss some questions after we conclude. I think I should have some. Huh? Yeah, we will do after we complete. But until this, anything is open because I feel finance is very new to us in FM because many people will not have that issue. Because I know in the operation, sometimes you will be dealing only with petty cash. Yes. Yes. Yeah. Nobody will try to teach us, in this. Nobody will try to. No, no, it's not only the finance, actually. Anywhere you go as a professional, nobody is willing to teach you because everybody is busy with their time and we cannot expect it also. The concept is why, it is based on the company's policies, how it is important. Because F1 can be taken in certain companies as only the service-oriented sector. It will support the service oriented. Some companies treat FM as a strategic FM for decision making, for everything they will involve. So for the people who are involved in that, will be connected to this. For other people, they will go on project basis only. For example, I have a site, I will go there, I will manage the technical part, I will manage the site there, then I will communicate to the management. In the office, there will be some people to deal with. This is vastly happening. This is the one vastly happening because there is no site that have separate procurement, separate finance and everything because these will be centralized in the offices. and FMs will be in the dedicated project. So for them to integrate with this setup is going to be difficult. They will not get the complete understanding. When they create the theories, curriculum, and everything, what they create is an entire FM covering a full building, covering an entire office. But we are not practically connected to that scenario. Because, for example, if I have a project XYZ, I will be in XYZ. I will be handling the operational aspects, everything, and based on the project only, I will know. In that project, what sort of additional thing that you can do? Only will cover that one. Will not integrate with my procurement policy. It will not implement my financial things, decision making, and everything. No. So it is about how the company is giving you that value that sets up the relationship between FM and finance. Because many people, when we do the lecture, they ask, okay, so I don't know this. I have to check this with the no. Because every time you will not have that opportunity as an FM. The last time also we discussed, you asked like risk management, who is responsible, FM or risk management? It depends on the company because some company have risk manager, some company have safety manager, but some companies they don't have. FM do the part of risk management or safety related thing. They will be responsible for it. Some companies they have a part time one, they will take it, but the authorized person to do this will be the FM. There will be an HSC officer for assistant, but the competent person to assess and give those reports will be FM. So it varies because FM is considered as a multidisciplinary field. It is not limited to MEP or procurement or something XYZ. No, because we cannot say no to anything. We have to do from cleaning to the complete maintenance. We have to do. So that's why integrating all other departments, for example, same like finance, we have to do with IT also. Because now in some companies they integrate IT into FM because most companies now in this setup what we see is IT is a separate department, right? But if you go to developed other countries, FM is the one managing IT. IT is completely under FM. We are not doing that. So it is part of the FM. So it is evolving. We should be ready to do that. Now for us, what we do, no, it's an IT related issue. We take it to IT department. So that setup will change. That's how it varies based on that. Now testing and commissioning. Very rarely FM is involved in testing and commissioning. Once you finish the construction, during handing over only, FM will come in. But FM should start in the designing. I think some other countries, they start in the designing stage itself. Some in the testing and commissioning, they make it mandatory, but designing also they are started. So the process, everything will be European countries. Even in Saudi, I have some of my colleagues. They are in the construction stage from the designing stage itself. Hmm. Yes. Then you are in construction, no? Like, how do we do the construction now? No, it's only 3 days. The owner will give you because if I am the owner, I go and I see a developer. I tell him, okay, I need a building. I need a 50-floor hotel building. Okay, he is the person to make a design, everything. He will hire everybody, consultant, structural consultant, everybody. He will make a proper plan and give me the drawings and the model and everything. Once I approve it, then they will process for the construction. That is called design. And during the complete construction stage, the design team will be there to ensure that the design is as per the proposed design. That's how the construction starts. So the problem is when they do the design, sometimes they don't consider the maintenance. Like here we face lot of issues now for the raining issue. What is happening here? And some maintenance related issue. When you go to some places, you would have seen the AC outdoor units be placed in rooftop. Sometimes there is no access. Humidity issues. There is no proper staircases getting rains. Right. So those are some practical scenarios. How you will at the outside facades. They cannot have approach. They put the facade inside and they cover it with the outside one. There is no person can go. Even the rope access or even the new, currently what they are using, the new technologies, drones. They are using drones robots to clean this now. Even those things cannot reach out. So these are some issues. So when you take a major construction, this I am considering about like a 50-story, 60-story building. There are very complex developments that is happening. No? So for that, how much will be the impact there. So if they involve a person, same like a structural engineer, HSC engineer, so they will include FM also. Then it's much important. No, they will cover, they will know everything from the start. So they can give their input and the thing can change. And the second case is the testing and commissioning, because what happens is handing over testing and commissioning reports they are giving. Whatever the issues they are giving, only they are accepting. But during the testing and commissioning process, FM should be involved. Then only he will come to know, okay, this is the design, this is what happened during the testing, and how do I do the retro commissioning. So these decisions will come only from that, right? So there are a lot of things that it varies, because we cannot limit it from, okay, this is what it is, and then I deliver it to you. These are the challenges. Okay. So the next thing is costing, fundamental cost concept. So I already discussed with you the difference between variable cost and the fixed cost, I think last time. And these are the main thing. Mixed cost or the total cost is the sum of that. But variable cost and fixed cost is the major one. So variable cost is a corporate expense that changes in proportion with the production output, as we discussed, like something very clear with the output that we are creating. Raw material cost. With the number of units I produce, it will vary. Right? If I produce 500 numbers, the raw material cost will be for the 500 numbers. If I put 1000, it will be for 1000. If I put for 1500, it will be 1500. So it will vary based on the number of outputs I create. But what about the fixed cost? About the rent of a factory? It's going to vary? No. Why? Because it's going to be fixed. So there are fixed costs, right? So fixed cost is an expense. Fixed cost is an expense or cost that does not change with an increase or decrease in the number of goods or services produced or sold. Right? It doesn't depend on whatever I produce or I sold. It depends as a complete permanent cost. Okay. Mixed cost is the cost that contains both fixed cost component and a variable cost component, and total cost is all the fixed and variable cost for the cost object. So this is actually important when you are doing costing. We are not going to do a costing. So, okay, for example, if this is produced, how do you do the pricing? For example, I'm getting this for maybe 10 riyal. Do you think this is the blind price they are giving? Okay, once the factory is out, they are giving 10 riyal. How this is made? Yes, the company who is manufacturing it will have all the details of the cost. So for them, the total cost or the variable cost is very important. So their cost team will allocate a cost for this marker, and then they will add the margin. That will be their profit. The production cost is 7, and they will add a margin of 3, and they will sell it for 10. That's how the full products or services are sold to us. So for that project, we need to understand how they cost it. There will be a lot of things to produce this. What will be there? Labors will be there, direct material, right? Whatever the plastic, ink, whatever it is, they are all raw materials used for this, right? This is directly involved with that, right? What about the factory rent or factory rent they are paying or something? Electricity bill, what else? Water bills, staff costs, transportation, marketing expenses. All these will be covered in this, right? So I trying to understand that is the fundamental cost concept. So fixed costs remain the same regardless of sales, and variable costs change based on our sales activity. So assigning cost to cost object. But this is what I told you. So cost objects can be direct and indirect costs. So direct costs, expenses that directly go into producing goods or providing services. One is direct labor, direct material, manufacturing supplies, right? These are general business expenses that keep you operating. One is rent, utilities, general office expenses. These are indirect costs, right? So we will take all these costs and allocate that cost to the project, right? So we need to understand direct cost and indirect cost. What is direct cost? What is indirect cost? So cost measurement system. So types of cost measurement systems are as follows: cost accumulation, cost assignment, cost allocation, cost tracing, and unit cost. So assigning cost to cost object, direct cost is cost tracing to cost object, and indirect cost is cost allocation. What is cost tracing and what is cost allocation? This is the important one. Direct cost, we studied, it will not vary with the output that we are creating. Sales value is different, direct cost is not going to change. So for material, whatever the cost that is involved, we are aware about that. If it is five real for production, then that is a direct cost. Means it is 5 real only. So that is called cost tracing. But indirect means cost allocation. Why? Because it is an assumption. It is an estimation. We cannot guarantee for which product how much it was spent. How can I say how much electricity this one consumes? We cannot say that because it will be allocated on the basis of assumption. This will be a mass production. Even if you can say, we will take total count and we will divide it. No, but even that also will not work. Why? Because they have to use it for other also. The electricity will come as a complete one, not the production wise. When they have a sub-metering or something, they will entirely, it is the company's decision to allocate. Maybe HR would have used the system, maybe finance team, all for selling only. So he cannot limit only for the production. He will calculate the cost and allocate that cost to here also. So that estimation and allocation of cost is called the indirect cost allocation to the project. So direct cost and indirect cost will be added to this project, and finally the margin it will be sold in the market. That's how the pricing works. Right? So unit cost in decision making. When the facility manager decisions such as this, it is important to understand the traditional and activity-based cost measurement system. So activity-based costing is traditional method. So it's just for an explanation only. So activity-based, you can see resources to activities to objects, and everything in the organization treated by resource drivers. What is actually being done and treated by activity drivers. And the other side, traditional resources to object, allocation basis, products and services. So this is they're categorizing it. Activity based means for each activity. They will separately categorize, okay, into departments. So you can segregate anything. Production wise, marketing wise, administration wise. These are activity. So they will put the costing separately on the activity base and then they will allocate it to that, right? So actually, we are not pricing or we are not doing the first allocation. It's just for understanding only. Because we are buying some item. You have to know the pricing. How you will judge it? Tomorrow somebody will come and say you, okay, for some exaggerated prices because you will be involving in daily purchasing of various items, consumable or anything. So for us, we need to understand how much is the cost, how it is happening, how much is the factory cost, all these things. So identify that. So that's why we need to have this understanding. We will not do any allocation or anything in the from the operation side for us. So next is differential cost. Differential cost is the difference between the cost of two alternative decisions or of a change in output level. So cost and revenues that differ among alternatives. For example, you have a job paying $1,500 per month in your hometown. You have a job in a neighboring city that pays 2,000 per month. The commuting city cost to the city is 300 per month. What is the differential revenue? And what is the differential cost? So what they say on differential cost is the difference between the cost of two alternative decisions. I have two options, two decisions I have. Then what is the cost I am incurring to decide that? Okay, A and B. If I choose A, what is the cost of losing B? If I choose B, what is the cost of choosing A? So here they give us an example. You have a job paying $1,500 per month in your hometown. And you have a job offer in a neighboring city that pays $2,000 per month. So the commuting cost to the city, because anyhow, if I want to go to a new town from my hometown, there will be a commuting cost. So that will be $300 per month. So the difference in revenue, differential revenue is 2,000 plus 1,500 minus it is $500. But the differential cost is what? It is the expense I will make for the commuting cost. If I choose the option B, then I have to make that $300 differential cost. That is called differential cost. Between two options, for going, what is the cost I'm using? So from hometown to a new town, of course, there will be a commuting cost. That commuting cost is called as the differential cost. Okay, clear on this? Then this opportunity cost. So opportunity cost, I think you would have heard a lot of things on opportunity cost. People talk. It's about the alternative cost. It's the value of a choice relative to an alternative. Simply stated, an opportunity cost is the cost of a missed opportunity. The expenses that is missed. I try to put it in this. If not, I have not saved that money. That is called an opportunity cost. Okay, for example, at the same time, sunk cost means a cost that has already been incurred in the past and cannot be recovered. Right? So you bought an automobile that cost $10,000 2 years ago. The $10,000 cost is a sunk cost because whether you drive it, park it, trade it, or sell it, you cannot change this $10,000. But what is opportunity cost? No. No. I have two options. For example, we'll go to this one. There is a name of job offer in neighboring country that pays 2,000 and 1,500. If I choose 1,500, my opportunity cost is 2,000. If I choose 2,000, my opportunity cost is 1,500. These are two alternative options. Because of choosing one, I'm losing one. Understood? That is called opportunity cost. Everything has an opportunity cost. Now I buy a t-shirt, right? I buy a t-shirt for 500, for example. If I buy that, what is the opportunity cost of that? If I don't buy that, I could have used that as an investment. I could have buy what do you call a mobile phone. So that cost for a mobile phone is an opportunity. Between two options, we need to analyze. For doing something, I'm losing something. That is called opportunity cost. Okay. So for us here, we discussed on many things. Okay. We don't need to remind on everything for IFMA or for anything in your operation also. But four things are important. One is direct cost and indirect cost. You need to know the difference between them. That is very essential. What is direct cost and what is indirect cost? And then how do we allocate it? Cost allocation. Direct cost and indirect cost is allocated to the object to sell a product. That's the basic simple concept. And then we have to know the differential cost and the opportunity cost. Differential cost is what? When we are having a two alternatives, the amount that we will be used, or what you call it, it's how do I say it? To choose one alternative, we might have to spend some additional cost to that. That will be a differential cost. As we discussed, 1,500 to 2,000, then 300 is the to check. Go to that 1,500, you need to make a differential cost of 300. That will impact you, right? At the same time, opportunity cost is also important. Between two opportunities, because of choosing one, you are going to lose one. The opportunity that you are losing is the opportunity cost. The alternative that you lose is the opportunity cost. Okay. If you are from commerce, you would have studied this in the economics, right? Opportunity cost. Huh? Yeah, in that is their opportunity cost. Okay. Are we done clear in this? So just we have an idea now on the finance, the terminologies, how it's being done, the basic thing. Now you have an idea. Now we have to shift to see, analyze and interpret financial statement. We discussed on balance sheet. We discussed on financial statement, right? We discussed on cash flow or statement. We statement of owners of owner statement of equity, right? All these things we discuss. Why we discuss about it? Why we need this? As an expert, why I will need it? Yes, it is to understand, but we already studied why we have not only the terminologies, as I told you before, we have two rules I said told you, GAAP and IFR to do the finding. Why? Because many people will use because as whatever he is doing in his own, if he do it in his own, I cannot understand or read or interpret his data. Right? If he is doing it in the generally accepted term or with the standard that is used globally, then what will happen? I will read and understand, okay, he has done this task one based on this one. This is based on this standard. So everybody will understand. Whoever will audit, they will know the reason. If I do it in my own, I will not know. Right? So why they want to do it? Because to interpret the data. I need to know, for example, XYZ company. I would say like, okay, this PNL is this month is 300 million. Okay, I know that it has a $300 million PNL profit, but I don't know the liability it has. In PNL, it will only show me what profit. What if the company before 5 years had a huge loan, huge liability, not paid? What will happen? The company didn't pay the shareholders the dividend for a very long period. Only this year it's gone. So how I will interpret? That's why we go data-oriented interpretation, because for us, we cannot see one by one in the values, right? They will give it in the ratio, because if you take a central bank report, I don't know how it is, but normally if you refer central bank report, they will give you the percentage of each company. If you take a company's individual company report also, every year they will publish no audited financial statement. In that, they will put all these ratios. These ratios will tell you what is the decision you should take. So we will be discussing on certain types of ratios on making or interpreting the data to take decision. The main part is to take decision. So the full entire subject of financial management module is not to do finance, it's not to do account, it's not to do the costing, but it's to take decision. As an FM, to understand the costing, to understand the finance, and to take decision. That is the main concept of this model. Even in ISMA, as I told you before, they will not ask you from book to book questions. It will be the practical based questions where you will have to, use this idea and put like how you will in practical scenario, how you will use it. That's all. Most of the questions will be like that only. Okay. So we'll go to financial statement ratio analysis, liquidity or short-term debt ratios. So the current ratio measures a company's ability to pay off its current liabilities with its current assets, such as cash, accounts, receivables, and inventories. So what they call is as a liquidity or short-term debt ratio, or the current ratio. What does mean? It's a liquidity ratio that measures whether a firm has enough resources to meet its short-term obligation. So for me, what I will come to know, liquidity means what? It is a state of a company to make quick cash, right? To settle its, or like, it's not about he has a needs. Not like no, liquidity means like, no, we cannot say it as a petty cash actually. Liquidity means like the entire, because every company will not have everything as a cash. There will be property, there will be investment, there will be everything. But we cannot run only with the investment, property, everything. There should be a certain amount of cash, because cash is the most liquid. Yes, not like we cannot say it as to keep. No, I'm not talking about reserving or keeping it. But what liquidity means is cash is the high liquid subject, cash, because immediately it can be cash. Yes, yes, something like that. So for a company, it should have a liquidity, right, immediately. Because if we want to sell a land, send a factory, it's not possible immediately. So what's the percentage of the liquidity ratio it has? It will show that in quick, short term, the company's ability to fulfill its obligation. That's the purpose of it. Okay. So one is current ratio that we see now. Then liquidity short-term debt ratios measures ability to current liabilities with its current assets such as cash, accounts, receivable, or inventories. Because what is current assets? We already discussed in the previous one, assets and liabilities. Current assets is something that we consider as something that can be converted within 1 year, right? So cash, accounts receivable, inventories, these all are almost near to the liquid state of cash, right? But cash is readily liquidable. Account receivable is what? Somebody should give me. Somebody owes to me. I consider it as a current asset. Inventories is my stock. That's are movable on daily basis. That is called current assets, right? And the current ratio measures company's ability to pay off its current liabilities. Current liabilities means what? These are the liabilities that are payable within 1 year period. So I need to see, for example, the company is doing good, but I don't have the cash to pay. For example, I have 500,000 liability to pay within this year, but I have only 50,000 as cash. But my company is good. Is it good for me? Within 1 year, I can pay only 50,000. No, then what will it show me? This ratio, if it is less, then what I will come to know? I need to make some liquid cash. I need to bring out some investment and keep it as a cash, because anytime they can ask me. Oh, so I have a liability limitation, but I need to pay it within 1 year. So without that cash, how I will pay? I need to make something which is not no in the not in the liquid state to bring it to liquid state. Either I sell a property, or I take my investment back, or if I invested in something, so that I have to do. I need to stop the dividend and give it to my team and take that cash and give it to the team. So that sort of decision making is important. So this is the current ratio, current assets divided by current liabilities, right? So the liquidity ratio that measures whether a firm has enough resources to meet its short-term obligation. Short-term defined within 1 year, right? So they have current assets 6,945 euro. Current liabilities 3,750 and the current ratio is 1.85. What does it show? What is this ratio of 1.85? Is it good? Is it bad? Based on the things that we discussed, what does it show? The current ratio is 1.85. How it will get 1.5? More than 1 mean what? Upper value is high. No, more than 1 means always upper value. The current assets should be high. So if the current assets is higher and current liability is less, then I will have more assets to to solve my short-term obligation. That is good for a company, right? In terms of anything, any bankruptcy, anything, I can immediately resolve it. That is called current ratio. Okay, I think now maybe with the numbers or numerical values, you will be more clear, I think, right? Okay. The next one is quick ratio or acid test ratio. It's a liquidity ratio that measures the ability of a company to pay its current liabilities when they come due with only quick assets. Right? Quick assets means less stocks. We know accounts receivable and cash are readily available. They are very liquid state is very high. But stocks, even though it's a current asset, uh, the way to sell it and get the money is going to be a little bit difficult, right? So excluding stocks, we say it as quick assets. So when you same formula, current assets, you will reduce the stocks, and then you will see current liabilities. Even that value is 1.5. So what does that mean? Even I don't need to sell my stock. I have enough quick assets to resolve my short-term liabilities. That means the company is good. I don't need to know who will decide all these things. The company or the lab. It can be anybody. If I'm getting a loan also, they will say, okay, in short term, we can settle my loan because why? He has more assets. If it is less, then what will happen? The company can decide, do not buy any short-term liability because we cannot repay it. The same time, whoever is giving it can think that we cannot give to these people because the company doesn't have quick assets to return to me in short time. The same time, everybody can make a decision, right? So this is another one. We are clear with that? Same formula. This is without stock.
Even bank is offering loan,
Yeah.
based on the available assets of the company.
Yes. I'm not. It depends.
Existing loan is they will not.
No. Like company based, there will be a lot of various scenarios. No, it will not be like one loan. They will get billions and billions of loans. So
How
how
those banks offering the billions of loans based on what?
based on their asset value and everything. But I'm saying if it's not only the what do you call the loans that they give it. There may be external financial companies, financiers, everybody can give. So if the company is opt to go with a what do you call a short-term current liability, that means a liability that needs to be settled within 1 year. You are a financial or a financial company. I'm going and asking you, I'll settle within 1 year. I need 2 billion. They will see how much they can take. That analysis only can be done. It's not about individual scenario whether they will pay or not. At the same time, the company also can decide, no? If I have a company, I have too much assets, too much operation going on. I can check one by one. So for me, I will check, the owner will check, okay, this is my ratio, okay. For the company's point of view, I cannot take more current, the loan that can be settled in 1 year, I don't need to take because I have less cash. I will go with long loan. I will put it 5 years, 10 years, long loan. Or else he will see, okay, I will sell some assets, convert it, and keep some liquid cash in terms of short-term liability settlement. So those decision making is taken from this liquidity ratios. That means how fast the company can resolve the short-term liability, how much they have the liquid cash or the cash of equivalent items. Right? Clearly, we cannot say the company, in case of our loan process, you will say the assets they will verify, company value they will verify. Yes, it's correct. But I'm saying on scenario basis for the decision making, they will check all these things. Then asset management ratios, stock turnover ratio. This is cost of sales over average stock held. I think you have studied all this in accounts. Cost of sales is 13,000. Average stock is average stock. How do we do it? The previous year stock plus the current stock. We will add it and divide by 2. That is called average stock. Okay. And we will put it and stock turnover is 10.2 times. What does that mean? Cost of sales is 10.2 times. Average stock held is less. Means what? There is more turnover here. We are selling more. We don't need to wait for somebody to say. If there is more sales, what will happen to your revenue? More revenue. So these are some of the ideologies when we for decision making. Because the company's financial statement will be like 500, 600 pages. So are we going to look one by one to identify everything? No, if you have ratios to interpret, okay, they give you something and they may ask you to make decision, then you have the idea of doing that. Okay, I have stock turnover ratio. Somebody will ask, the stock turnover ratio is this 15%, 15 times. What do you think about this company? Then I can explain to them. Okay, that means the cost of sales is higher than the average stocks that we are keeping. 15 times stock turnover ratio of 15 is very good, right? We expect more sales here. It's a good revenue can be taken with more, something like that. So that will be used to make decision making, right? So this will come under asset management ratio. The initial one we checked is for liquidity ratio. Now we go to profitability ratios, right? This used to assess a business ability to generate earnings relative to its associated expenses, right? So one is gross profit margin, which is created by gross profit divided by sales revenue into 100. Gross profit is gross profit is 200,000. Sales revenue is 800. So the ratio is how much? 25%. What does it mean? What is gross profit and sales revenue? We have discussed it already. Sales revenue is okay. You have a product, you sell it for X amount. That number of units sold into that X price of one unit is called the sales revenue. But are we taking everything as a revenue? No. Why? Sales minus cost of sale is what? Sales minus cost of sales is revenue. Then from that, what you do? Total revenue. From the total revenue, you will deduct some cost for gross profit, cost of sales. Once you minus the cost of sales, you will get the gross profit. From the gross profit, you will minus the expenses, administration, marketing expense, blah blah thing. That is called net profit. And minus tax, net profit before tax, net profit after tax. That is how it will come. So gross profit means what? Sales, total sales minus cost of sales. So if gross profit is 25% means what? If I am selling certain amount of item, 25% of that is my gross profit minus cost of sales. Right? So I can assume, okay, I send X percentage of things is my cost of sales. Okay, out of that X, divide by 4, 25% of that is my gross profit. So that can be extracted from there. That is the purpose of doing this. So that's a profitability ratio. One is gross profit ratio, gross profit margin. Next is operating profit. What is operating profit? Now you can see in the picture. Revenue minus cost of sales is gross profit minus selling and general admin is called the operating income, operating margin, right? So operating profit is operating profit minus sales or revenue. Right? Operating profit divided by sales or revenue into 100. So operating profit margin is expressed as a percentage. Right? 8.8 percentage. Yeah. Based on profit they are getting. Because how? Because you don't need to analyze the complete one. If somebody is giving you the percentage itself, you can easily identify and say that, okay, this is because of that. And from this, I will take this decision. That's it. So for that, you need to understand, okay, for us, we need to understand what is operating profit, how it affect the P&L, what is gross profit, how it affect the P&L, what is sales, what is cost of sales, what is revenue. These things we need to know. This is what we study. And through this ratio, how they are going to impact, that we have to do. Right? Clear with you? So here you can see net profit margin. Net profit Margin is the percentage of revenue left after all expenses have been deducted from sales. So now you can see a P&L. Revenue, total revenue, cost of revenue, and cost of sale. Then they take the gross profit. Then from the gross profit, they take expenses. There's a depreciation, unusual, other operating expenses, everything. Then they get the operating income. From operating income, they reduce what? Interest, right? And then income before tax. And if there is tax, depends on country's legislation and all. Income after tax, and then extraordinary items, if any, and then finally it will be net income, right? So we will have to divide it everything. Now you can see decreased profitability ratio, gross profit ratio is what? Gross profit divided by total revenue, 44%. So what does that mean? 44% of total revenue is the gross profit. Am I right? It's my total revenue, because total revenue covers everything. Right? So 44, I cannot consider as a revenue. If somebody asks me, okay, he gives the revenue and he gives the ratio, 44%, and asking you the gross profit, what you will do? You will make subject of formula and calculate and give it, right? And similarly, operating ratio is what? Operating income over total revenue. That is 22. Net profit is similar, net profit over income, that is 16%. So this is good overall, right? Everywhere there is a big margin. Clear? So the company can decide, okay, either to increase the margin or to decrease the margin. They can take a decision. Now, for example, the sales is high. They can check from where they can reduce gross profit ratio. They can bring it down. They can operating income. They can check and see like how they will, because mainly the changes will be impacted from the cost of sales. So there are a lot of adjustment they can do. Right? So these ratios are the one we use to make decisions. Right? So we study liquidity ratio, asset management ratio, and profitability ratio. Under these, there are a lot of ratios. Current ratio, we study gross profit, net profit, and operating profit ratio. And then we study this operating profit margins. And here stock turnover ratio, asset test ratio, and current ratio in the liquidity ratio. There are many other ratios as well. So how do we use it? This is return on asset. For example, Apple's return on assets is 27.6%. Microsoft is 23.77%. So net income over average total assets is the return on assets. So net income is how much? 25,922. Average total assets is 95,777. What we will decide on this? To the worth of total assets, how much profit it is generated. That is called return on asset. This much of assets it has, and these assets generate this much of profit. Clear? So for me, what I will, if you are going to invest in Apple or Microsoft, which you will invest? You will invest in Apple, because why? It creates more profit from its assets, 57%. So this is how we decide. So return on assets is an indicator of how profitable a company is relative to its total assets. Okay. Return on equity is the same. That will be net income over average equity. So you can see here, Apple total shareholder equity is given 2010 and 2011. The average is 62. And Microsoft total shareholder equity is given 51,629. Right? And the net income is already given. So when you divide it, because equity means what? The investment, shareholder value. So from here, what you can see, Apple is 41.67, Microsoft is 44.84. Right? So what does that mean? For every investment, this is high. Microsoft is high. Right? Return on equity is high, 44.84. Yeah. Assets is different, investment is different. Return on equity means equity is what? Capital investment you have made in, or the share investment that you have made in. So how much return it's giving is called the return on equity. Based on return on equity, it's 44.84% for Microsoft based on the value, and Apple is 41.67. So as for me, if the equity is higher, then I will go with Microsoft, right? Return is good. So return on equity is a measure of profitability of a business in relation to the equity, also known as net assets or assets minus liabilities. ROCE is return on capital employed. It's calculated by dividing net operating profit by employee capital. Yeah. How do they do it? Operating profit minus capital employed. Operating profit is given. Capital employed 1.4 million. And if you divide, you will get return on capital employed. 20%. What does that mean? The same return on capital employed. How much capital we are employing, how much operating. For the capital we are investing, how much is the operating profit we are getting? Operating profit means what? It is from the gross profit minus the operational expenses, and then you are getting operating profit. So if I'm investing, I will generate this much of operating profit. 20% mean I can say, okay, if I invest 100 rupees, 20% of that will be operating profit. So I can easily say, if I put 1,000, how much will be? 200 will be operating profit of that. So I can easily identify. That's how we assume from the ratios. So the facilities management, so that's about ratios. We are done with that. Okay, it's just about decision making. Please go read this and see. Facilities management metrics and ratio analysis. FM is a cost center, as we discussed. In other words, facilities do not generate income, right? And strategies for cost containment. This we already discussed. FM is a cost center, as always, and facilities do not generate income. Majority of the cases, they do not generate income. So what we do is the cost containment, saving approaches. How do we contain the cost to make us a profit? So cost containment strategies, the business practice of maintaining expense levels to prevent unnecessary spending or thoughtfully reducing expenses to improve profitability without long-term damage to the company. This we discussed before also. Even if you have what you call more budget, but we will not spend as we want, right? Because why? We will save it and do it with optimized resource and optimize, efficient and effective. That is how we have to contain the cost. Everything you spend, you will see, okay, this is best, this we can spend, this we cannot spend, this within the budget, not within the budget. That is called strategy for cost containment. Effective implementation of cost containment strategies. A successful implementation of program must be able to face potential challenges, such resistance from the employees, contractors, and customers. Therefore, proper change management must be in place to overcome the obstacle. We will study the change management in occupancy and human factors also. But as per here, what will be the cost containment means everything. Now, for example, you go to your office and you say, okay, I will not give you paper cups to drink water. I'm gonna make one. You have to bring your cup from your home or bottles from you. That's a good proposal because you will be spending how many per day? If you have 20 employees, they will bring 3 times, 4 times water to the small cup. You will be spending per day hundred of plastic cups. The waste to environmental waste, plus we are wasting a cost also. It's a cost containment option. But will everybody accept it at the first go? No. If you are saying it to me, I will not. I will say no. Why we are doing like that? It's very practical. Somebody is paying that money. What is the problem for you? We will buy. We will use the same one. What is the issue? Many people, why people doesn't want to change, reluctant to change. So we need to face that issue. It can be just one example like that. So if you are making lot of other things also, it will be the same. If you switch off, ask the team to switch off the lights when they are going. If they are used to it, it's okay. If they are not used to it, of course, there will be a problem. You move from your company to another company. You make some new changes. Of course, there will be reluctance. People will not agree with it. So we need to know how to tackle it. That is called change management. So we need to have proper change management practice before we implement anything. So cost containment, it's good. But if you do it, you will have reluctance. So to control the reluctance, you need to have good change management. Water bottles. Okay. Okay. Yeah. Five per day, and the dispensers are there. They have to take them, and they need to take from dispensers. Because that's a saving point. Why? Because the five bottle, even if it's even in the morning, I will not drink that five. For a month. Six. That's total bottles. I mean, yeah, 30 means 20, almost 20, 25. But that's per day. Per day. Per day. Yeah. And
easy to give them. Keeping on
1%. That's another additional cost. And plus environmental cost. All these plastic bottles are dumped. Almost 6,000 real.
No, 8,250. But the wow, for manpower new
But now, when the second time, if they give five bottles for each person, either they ring it or no, they will go take it in the car when they go and everything. They will waste the water. Everything will happen. Now, this water bottle means they will take only water. And the second thing is consumption also will reduce. They will feel more. There will be less. Because they will not feel to go fill the water again, come and sit here. Then they will not like. Yes. So that's an option that they do. It has everything. See, that's a sustainable option. Why? We have safe cost, environment, and then for the people also social. So it happens based on scenarios. So we will move to the final one. This is called chargeback. How do we charge back in the FM? A system of cost control that requires that requesting unit or organization to pay for work done to its area. So chargeback can also be financial penalty for non-compliance with the customer requirement. This is inside an organization. For example, I am an organization doing, and I have an internal FM department. But the FM is a cost center, as we discussed. How do I charge it to the resident? Because everybody is benefited, right? There will be marketing, finance, everybody is using AC. Only not the FM is using the AC. Electricity, everybody is using the electricity, but utility will come in FM. How do we charge it? We charge to the resident. So most of the companies, hybrid companies, what they do, they have a cost center. They divide each department and they know per head how much is costing or per square feet how much is the cost. That is how we charge back. For each department, they will charge it. If you see big company, they do this one. So internally, they will calculate and see. So they will know, okay, finance is spending high, marketing is spending high. They will know everything. Even printers are connected to that. How many prints they are taking. Everything will be costed.
I know what.
Yeah.
Like they will micro impact even the micro.
Hourly basis.
Believe it.
Okay.
You cannot make even even if you print, it will come the print also. If you are take the passport.
Yeah. Yeah.
I don't think for every country.
Yeah. Yeah.
Some reasons you want to
Print the passport.
ID card.
Yeah.
Not passport card. When you are seeing the print of thousands of people cutting along with the company, this company actually generated also time. They will be okay. Even with the company logo. Every month they will count how many people have
Been taken. Yeah. Yes.
Then how the email has been generated.
Emails they are checking because normally how is the response, how they are analyzing the people. That's been done most of the companies. They check that one. All MNCs they used to check how many emails you receive per day, how many you are responding. That in their IT level they can check this one. Okay.
The files,
Yes.
you can use the file. You cannot copy it.
Yeah, that's a security. We cannot copy. Even the PDF we are generating, we cannot edit.
Have experience. Oh, I know.
Hmm.
You cannot.
No, that we cannot say, that's a safety protocol because people don't use it wisely. Yeah. Sometimes, they misuse. We use for emergency, it's okay, but people not like that. They bring personal thing, they print out. So they are very concerned on that.
Single document from the previous. Before the help design.
Yeah,
No,
nothing.
point three. Meanwhile, there are the respect to related restriction in that different restriction. There is a overall. There is a people
Who knows how to do?
that company know everything and how to print it. And they will teach some secret to people.
But it's okay, at least we have been in that environment, so you know how the costing is done. It is because to allocate that particular things and to control that cost. From that side, it's maybe if you run in the FM, maybe you would have done that one. Because all these things will come under printer, everything, printing, everything will come under the FM department only. Right? So we'll go to chargeback. Chargeback is same as what you were suggesting. Charging to the particular department, requesting unit or organization to pay. Yeah. Hmm. Okay. Like a compliance mistake. Yeah, that's very common, no, for NCR. They used to do for everywhere for it. The client is now, they want to charge back for everything. So, okay, these are called chargeback. The penalties for non-compliance with the customer requirements. So now we will go to procurement. This is another part in FM. In finance, procurement is also there, right? Yeah. So procurement is the process of finding, agreeing terms, and acquiring goods, services, or works from an external source, often via tendering or competitive bidding process. Right? It's not only purchasing. Purchasing is different, tendering is different. Procurement is also different, right? So purchasing is the process of how goods and services are ordered. We create a PO and then we get it, right? So purchasing is procurement. So procurement is vendor selection will be there by pre-qualification. Vendor evaluation, market research, and contract negotiation will be there, right? That is called procurement. Whereas purchasing would be request for quotation. You will have a RFQ and then approval, purchase order issue and receipt of goods. That's the process of purchasing. Right? So procurement process is not the same on each organization. Some consideration for bidding are as follows: RFP, invitation to tender, RFQ. What is RFP and RFQ? Invitation to tender, ITT, you already know. We raise a tender query and then we will get from the tender submission and then we will evaluate the tender. But what is RFP and what is RFQ? Yes. But what is the main reason? Both are same. We are submitting.
What's our expenses? Measure activity.
No, no. The proposal means actually RFQ means quotation, which will mean you give the scope of work to me, and they will quote based on the scope of work we provide. Proposal means you will not give the scope of work. You will send an RFP. They will evaluate the site, everything, and they will submit their proposal. That's the difference. RFQ and RFQ. And contracts may be awarded for the following factors: maybe lowest bidder, evaluated based on the money best value and risk assessment. That is simple. And procurement and facility management outsourcing. Outsource, we already know. Outsourcing is a version of the make or buy decision, commonly used for services in which firm elect to purchase an item or a service that previously was made performed in house. Right? For example, we We cannot do everything in-house. FAFM may be outsourced. Right? Generator may be outsourced. Depends on company. Swimming pool may be outsourced. But FAFM compulsory outsourced because it needs a certified, usually certified contractor. CCTV. Right? So it's a combination of in-house plus outsourced. FM will work together with in-house with outsourced. Sometimes sub-services can be outsourced. Right? Sometimes technicians can be outsourced. It depends. So outsource is a part of FM. Right? Outsourced team is a part of FM. These are general things that we have put it because sometimes people attend without knowing the background of FM. So for them, they need to know this outsource. So these are the reasons why FM need to outsource. Cost containment opportunity. Expert not available in-house can be obtained. Flexible cost, flexible resources, increase the capacity of services not available in the house. Opportunities for FM staff. Outsource eliminates capital investment. Outsource non-core function of the organization to allow to concentrate on expertise and resources available in-house. So these are the major ones. You know that when we outsource, what happened? But at the same time, there are risk also for outsourcing, right? The control will not be there, right? You cannot trust the skilled capacity of the team. They say they are very skilled people. After 2 months, you come to know the actual performance of the team. And at the same time, you cannot change. Sometimes there will be client restriction to change the people on frequent basis. So you will be getting stuck with the unskilled people. There will be challenges. But these are some of the reasons why we need outsource some benefits, right? So risk here is there outsourcing benefits and risk. Improves focus on business activities, increase efficiency, control cost, increase reach, and greater competitive advantage. These are benefits. At the same time, risk is service delivery, confidentiality and security, lack of flexibility, management difficulties, and instability. That is risk. So contracting facility organization. So this we can discuss in the next class because this I need to elaborate a little more. So for now, is it clear for us in everything we studied? Finance, procurement, finance interpretation, financial management, assets, everything. So we can wind this and we can finish it tomorrow, discuss the next class, discuss some questions, and then we can move to the 5th chapter, occupancy and human factors. And maybe you can study and ask me, I don't know how many of you are going for it. Now, for the people who read it and ask me the question so we can discuss time to time before we close it. Right? And I need a change in the schedule for this Wednesday. I want to shift this class to Thursday. Will it be okay for you? 7 to 9? 7 to 9? Only for this week because Wednesday I have some other commitments. And I have already discussed with them. I have missed, I think, 2 to 3 classes before. I'm planning to have one Friday, one class for 4 hours. We can finish one chapter there to cover. So if your guys are okay, then it's okay. For 1 week, that date, I'm not forcing it now. We will do it whenever you guys are free to finish it. Not this week, not next week, even the upcoming week, even the online. So whoever, everybody, I will put a poll in the group. So you can let me know which week it is. I will put week 1, week 2, week 3 from which month. So you will choose and you will give me because as better and earliest week close is good for us. And unfortunately, I was sick. I missed 2 classes and I had some other schedule. Sometimes it gets delayed. But we want to finish it everything within the time. So based on the discussion, we will decide. And are you okay for this Thursday? I can shift it to Thursday. Okay. And the online students, you have any problem to shift this class to Thursday for this week? Anyone?
What time, sir?
It's the same time, 7 to 9.
It's okay. It's okay, no issue.
Okay. I will post it in the group as well. Only for this week. Next week it will be the same schedule on Monday and Wednesday. And Friday I will post it in the group. We will discuss and decide. Thank you guys. If any doubts, please come read it and come back to me on Thursday. Please check. And advise. I'll share the question session also. We will discuss on Thursday. I will not share it because it's I don't have it answers. And we will discuss it on Thursday.
Okay, thank you so much.
Thank you everyone. Thank you. We are in the 4th chapter. Actually, there are 11 modules. So I'm planning to